Good morning, everybody. This paper is a collaboration between me and Dr. Hanan Nasser from Arab Open University. It's still a working paper, so did not finish all the analysis of this paper. So the title is summarizing everything. So we are going to have gold prices, oil prices, and stock market. So I'm talking about US stock market. I'll go with this, start by an introduction. I'll go through the estimation process, then the data that I have used, some results, and finally we'll conclude. Investing in commodities have grown very rapidly during the last few years. And it is particularly, or the popularity of investing in commodities is because the people are thinking that this is another or alternative class of assets rather than the traditional class of assets, which are stocks and bonds. So they are trying to invest in both sides rather than investing in stocks. They are going to the other way, which are called the commodities. The returns of those commodities, like gold, silver, or copper, or even cotton or corn, okay, the return of this has very small correlation, or sometimes a very negative correlation with the traditional assets like stocks and bonds. So that's why they are going in that side. And why is that? The reason behind the correlation, the negative correlation, or sometimes small correlation, or even no correlation between these two, is that the commodities, the returns, are determined by factors like weather, geopolitical conditions, like supply constraints, that are not determining the stocks. So that's why they are having this small correlation. And sometimes they take the investment in commodities as a hedge against inflation. And why I say that, this is a point of debate. Investing in gold, sometimes it is not hedging against inflation. There are a lot of papers talking about this, that they conclude that gold is not a hedge against inflation. But some papers have concluded that it is, but in the long run, not in the short run. So this is from one side. The other side is the joint movement between oil prices and gold prices. So if we go and look at the past results, or the past flow charts, or graphs of oil price and gold prices, for example, this, you can see we have gold prices there, and West Texas oil price. In early 2000, the price of oil per barrel was $25. By the mid of July 2008, it increases to the maximum historical value, which is $145 per barrel. At the same time, the gold prices also hikes to $1,000 per ounce. So they are increasing with each other. Then, by the end of 2008, the price of oil dropped to $30 per barrel. And at the same time, the gold prices also dropped to $800. So from $1,000 till $800 per ounce. So they are moving together. Then they continued to increase again. Oil price reached $112 per barrel in April 2011. And the ounce price was $1,500. So this, we can see that there is a movement together between oil prices and gold prices. What's the reason behind that? There are a lot of transmission channels between these two. One of them is that when, for example, the oil exporting countries, when the oil price increases, so they are benefiting from that. So where do they invest this much of money that they are gaining? They just go and invest it in buying gold. So demanding a lot of gold increases the price of gold. Okay? So this is just an introduction for the three variables: stock prices, gold price, and oil prices. So a lot of papers have looked at the relation between these three variables. So if we go to this literature, a little bit literature about the portfolio diversification, because the investors are looking to diversify their portfolio by investing in a stock market and gold prices, for example. So we have those papers that are looking at the relationship between stock market and gold prices. And then the second, stock market and oil prices. The last one are oil prices and gold prices. Therefore, the objective of this study is to examine the volatility transmission, not the impact. It is not the direct impact. There is fluctuations in all the prices, so stock markets, oil prices, gold prices. So I'm looking at the volatility transmission between the different indices of a stock market. So I'm using SP 500, NASDAQ, the all stock market of USA, oil prices, and gold prices using this model, which is VAR-GARCH. Then I'm going to employ the results of that model in estimating or calculating portfolio weight. So if I am investing in stocks and gold, what should be the weight of that portfolio of gold and stock? Or if I'm investing in stock and oil, what should be the weight? Okay, so if I'm having two thingies in one portfolio, what should be the weight? And what should be the hedging ratio? And then the hedging effectiveness. So in order to do that, I apply this model where I have on the left-hand side, I have R, which is the return. So sometimes I take the return of stock, or return of gold, or return of oil. What do I mean by return? It is the change. Change in stock prices, change in oil prices, or change in gold prices. And on the right-hand side, I'm putting the lags of each one of these. In addition to that, I'm considering this equation, which is the conditional variance equation, which is the most important equation in this model. So I'm looking at the volatility transmission between, so I'm not looking at the change only, I'm looking at the fluctuations in prices, oil prices. How does it affect gold prices? And how does the fluctuations in gold prices affect both oil and stock? And how does the fluctuation in stock prices affect both oil and gold? So I'm looking the interaction between three terms. So here I have, this is just econometrics. So I have the variance, the lags of the error, the lags of the variance. And here I have, I'm accounting for the asymmetric impact, whether the positive impact is different than the negative impact or not. So in order to do that, or to continue on the calculations, here I'm looking at the weight of, for example, stock in a portfolio or gold in a portfolio. So W means the weight. And here the beta calculates the hedging ratio of a portfolio. So these data are used, SP 500, Dow Jones, NASDAQ, Russell 200 stock price index, WTI gold prices, and that is from November 2000 to April 2015. So these are daily data, which sums in 1,943 observations. Okay. After estimating that model, I got these results. A lot of things. I'm not going through each one of them, but the first part is mean equation, where when I get stars, the stars mean significant impact. where the variance equation shows me the variance or the volatility transmission between those. So for example, if you look at the second one here, gold return, I have 0.025 double star from the variance of oil on the gold return. That means there is volatility transmission between oil prices and gold. Okay, so this is one of them. And for example, the 3 rows at the bottom shows the asymmetric impact. So the increase in any one of them affects differently than the drop in any one of them. This is what I mean by asymmetric impact. So these results are then used to predict those fluctuations in prices, and then I have used it to calculate the weights. And I have used different models, different specifications of the same model. They are giving almost the same results, but just look at the first column, which is VAR-GARCH. There is the WSG, that means the weight of gold in a portfolio which has stock and gold. It comes 0.431. That means we have to maintain 43% of the portfolio of gold and the remaining of stock. The next one, WOG, means if I have a portfolio of oil price and gold, I have to maintain 77.6% of gold and the remaining of oil, and so on. The same was applied to the other stock prices. So these results are on SP 500. Those results on the NASDAQ and Dow Jones. So what I'm concluding from this, I'm getting a significant volatility spillovers, volatility transmission between the 3 variables that I have studied. And the optimal portfolios, if I have stock and oil, then I should maintain the stock investment risk, should maintain lower weight of oil and higher weight of stocks. And the other way, if I have gold and stock, then gold should outweigh the stock. And this should be used in diversifying portfolio for investors. Thank you very much for listening.